My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. People want to make friends. I'm just trying to make you some money. My job is not just to entertain you, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Welcome back to Bizarro Wall Street, where bad news is good news, at least when it comes to the economy. This morning's jobless claims number came in disappointingly high. That is terrible if you're looking for work. But it's fabulous for Wall Street because it means the Federal Reserve won't feel compelled to raise interest rates anytime soon. See, Fed Chief Jay Powell wants to keep fighting unemployment rather than inflation. And this not-so-hot data makes it easier for him to stick to his guns and for growth stock buyers to come out of the woodwork and buy their faves again. And that's how the market could rally, with the S&P jumping 1.18%, new all-time high, Dow advancing 172 points, and the Nasdaq, where all those once-for-loan super growth stocks live, surged 1.76%. Now, I know it sounds counterintuitive. If you want higher stock prices, you need two things, though. You need better-than-expected earnings and bad, non-inflationary news about the economy. Buy! So that the Fed doesn't see the need to tighten. Today, Jay Powell got a terrific excuse to keep easy money flowing. And you know what? That's exactly what's needed after President Biden rolled out a massive $2.25 trillion jobs program yesterday. Which brings us to our game plan. Now, tomorrow we get the Labor Department's monthly non-farm payroll report. And we had the day off, for heaven's sake, but they're still doing that. Now, it might be softer than expected given today's suboptimal jobless claims. Remember, that's what kind of got people going. The market's closed for Good Friday, but when we come in on Monday, we're going to be reacting. All right, we're going to be reacting to the number that comes out tomorrow at 8:30. And once again, bad news is good news. Wouldn't shock me if it's weaker than expected. On Tuesday, we have an analyst meeting from a company with one of the strongest stocks in this market, Applied Materials. I think the semiconductor equipment maker may use that meeting to raise numbers, perhaps substantially, because of that worldwide chip shortage we talk so much about. So demand for manufacturing equipment is just off the charts. You know, last night, Taiwan Semiconductor, one of the most forward-thinking companies on earth, committed to spending $100 billion in equipment over the next 3 years. That's an increase from what it's been talking about. No wonder Applied Materials and its peers, KLA and Lam Research, have all been red hot. Later in the show, we're going to hear from Micron, the commodity chip maker who really deserves to be called a proprietary chip maker these days. They reported a stunningly good quarter last night. They told a story of incredible demand. I expect semiconductor prices to keep soaring, so chip makers will keep needing more capacity, which means a stock like Applied Materials, up an astonishing 64% this year, should actually, amazingly, have more room to run. We also hear from Paychex, and I expect it to trade down no matter what the company has to say. Why is that? Because it's a post-earnings pattern. This incredibly consistent payroll processor and human resources consultant has had to deal with this almost seemingly for years now. See, there are a bunch of negative analysts who've been wrong all the way up. They'll most likely stay wrong, giving you a chance to buy Paychex on weakness, even if it reports a great quarter. Hey, speaking of weakness, I got to clear something up, all right? I just got to get this off my chest since it started this morning. I was dead wrong about CarMax last week during the game plan. I figured this huge car dealer was almost a can't-miss situation. I thought they reported a great quarter today, and I said that to you, because there is such huge demand for vehicles right now. Look, we just had Carvana. That was magnificent. Lithium Motors is just incredible. But there's been not enough new cars thanks to the chip shortage. So I figured, how could CarMax blow it? But they whiffed, giving us a disappointing top and bottom line miss. The stock plunged 7% today, though. I have to tell you, when I read through the conference call, as sick as I was because of the decline, it did make me feel there was a bit of an overreaction. I think CarMax stock is very attractive coming out of the pandemic, but the call rubbed the analysts the wrong way because they're like me. We all figured they had to do a good number. In other words, today's pullback might be a good opportunity to buy the stock. Future will be brighter than the results lead you to believe. But they, and yes, I, should have done better for you. Before the open Wednesday, we get the weekly mortgage application numbers. We need to see continued momentum in housing. That's been one of the strongest themes in this market. I think it remains a great story as long as interest rates stay low, or at least relatively low, because so many people are moving from the cities to the suburbs and the country. They actually literally go out to the country. That's why I like that Tractor Supply in response to the pandemic. Even if the economy reopens, it looks like remote work is here to stay. Lots of big companies are adopting what's called a hybrid schedule. Some days in the office, some days working from home. And that's going to keep boosting the housing market for a long time. A world where you can work from home is a world where you can tolerate a longer commute if it means you get more space, which is exactly why so many people are abandoning their apartments. Next up on Thursday, we got a plethora of big names reporting. First, we hear from Constellation Brands and ConAgra. And then Levi Strauss there for the close. Now, Constellation got hit with a negative research pieces the other day that suggested that the beer and liquor company, which is a fantastic grower, might deliver a light quarter thanks to weakness in Texas. See, the devastation from the superstorm Uri, which, again, I keep pointing out has not been written about or talked about enough, may actually hurt their earnings. Texas is a big market for them. Now, you know Constellation is the maker of Corona and Modelo. It's been responsible for all the growth in its category. And long-term, I think betting against this company is a mug's game, so stay close. Remember also, if Washington ever legalized marijuana nationwide, Constellation could step up the best cannabis company I follow, Canopy Growth, because they already own a huge chunk of it. What a kicker that could be. How about this ConAgra? It's been able to put up some good numbers thanks to some excellent brand extensions and some acquisitions. Its dominance in the frozen food aisle. Now, I do worry, as with all the other food companies, that ConAgra might temper its forecast because of concerns about the great reopening. But this has been one of the standouts in a pretty anemic group. As for Levi Strauss, we've been huge supporters of this one. While others fled the stock en masse as the pandemic washed over the market last year, we urge you to stick with it. And I'm glad we did, because it's come roaring back. So many investors were worried about retail in general and apparel in particular, but now they're beloved as plays in the great reopening. I just wish Levi Strauss's stock hadn't run so much going into the quarter. We know PVH ran up huge into its results, and then the stock got blasted after a fairly good number. So why don't we see how Levi behaves going into the earnings? Friday, we get some insight into a number that I really never used to care about, but into the producer price index. See, this is the big fear right now, that one. Look, I see the inflation in lumber. I see it in plastics. I see it in metals. I see it in semiconductors. I think this PPI number could run in hot. So should you be nervous about it? Remember, when Jay Powell vowed to keep rates low last time, he also added that the inflation would spike near term. In other words, he was saying this is going to be a bad number. Next Friday, we get the spike, and the market should be prepared for it, because he told us to be prepared. But that doesn't necessarily mean it's totally baked in. The bottom line, with still one more record gain in the S&P 500, you think we're pressing our bets here to stay long? Yesterday, I suggested that the counter-trend rally in tech could continue for a few more days before it ebbs. So far, that forecast stands. But without a cool employment number tomorrow, I expect the reopening stocks, think the banks and the industrials, to come back into vogue on the Wall Street Fashion Show sometime next week.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.